You had over $100,000 hit your bank account deposits over the last 12 months, but the bank says you still don't qualify for a mortgage. That's not a you problem. That's a tax return problem. Great news, there is a loan program specifically built for you. I'm Ryan Marks, host of SCI Mortgage Podcast. In today's episode, we're going to break down how the bank statement loan works and why you don't need tax returns to buy a home if you're self-employed. So I'm very excited about this episode talking about the bank statement loan. This has to be currently the most highly utilized non-QM loan product currently available. A bank statement loan mortgage, simply put, uses 12 or 24 months of your bank statements to derive your monthly qualifying income. There's absolutely no additional income documentation needed. That means no tax returns or profit and loss if you are a self-employed borrower. This loan can be used to purchase a primary residence, a second home, a rental property, or you can even take cash out of your existing property using a bank statement loan on a new first mortgage and even take out a home equity line of credit. So how does it work? Well, it's pretty simple. You will provide your loan officer with the most recent 12 or 24 months of your bank statements, and your income will then be calculated using the deposits that went into the account that are considered income earned from your profession. So depending on what you do for work, then an expense factor will be applied that results in a number which becomes your qualifying income. So what is an expense factor? It acts in place of the write-offs that you would typically take when you're filing your tax returns. In other words, the expense factor means exactly what it's stated. It's the expenses that equals your business. So depending on your profession, this expense factor can range as low as 10% up to a 50% expense factor. There's very basic documentation and requirements needed in order to qualify for this bank statement loan product. So the first thing is, typically when you're self-employed, you have to be in your profession at least 1 to 2 years, whether you're utilizing a qualified mortgage or this non-QM bank statement loan product. But if you've been in the field, meaning you were previously a wage earner and you have experience in that field, and now you're 12 months in, regardless of where you're at in the year, you can use your most recent 12 months bank statements to derive the income now that you're self-employed in that profession. After applying that expense factor, you would need to prove that you are self-employed. So if you're incorporated or you have an LLC, you would simply provide the supporting documentation, or if you're a contractor and you have a business license, this would show how long you've been in your profession for. But if you're, let's say, a sole proprietor, meaning you don't file any sort of additional business return and you're simply maybe running an e-commerce business like Etsy, something to that effect, and you have a bookkeeper or a CPA, they can also provide you with a letter to support that you have been self-employed for at least 12 months. So most of these programs also require no additional reserve. So what that means is sometimes when you're purchasing a property, the investor that you're going with wants to see that you had additional funds available just to ensure that you can continue to make your mortgage payments. Things change within your business. So that could be 3 months reserves, 6 months reserve, or even up to 12 plus months reserves. So why that's important to point out is when you're working with a loan officer or typically a mortgage broker for that matter, not one mortgage broker fits all. So why that's important to understand is because if you're working with a loan officer who's typically a mortgage broker, it's not a one size fits all scenario. So a lot of mortgage brokers offer the bank statement loan product. In addition to that, there's tons of investors that offer this bank statement loan product. So if you're working with somebody that maybe only has access access to one or two investors that offer a bank statement loan product, you're limited to just what their guidelines are and how to qualify for that loan program. Whereas we have over 200 investors that we work with consistently with all of their own different sets of guidelines to ensure that we put you in the best loan program if you're utilizing a bank statement loan or whatever particular loan that best fits your income situation. In addition to limited to no reserves needed, the debt to income ratios also go higher on bank statement loans as opposed to a traditional conventional loan. So if you're utilizing a conforming loan, you can only go up to a 50% expense factor maximum, where a bank statement loan often offers a debt to income ratio up to 55%. Right? You'd have to provide some compensating factors. However, there are investors that will go as high as that 55% DTI ratio. So what is a debt to income ratio? Well, we did briefly cover that in the last episode on non-QM versus QM, but essentially it's just the amount of your existing reoccurring expenses, including the new mortgage, divided by what your qualifying income is, will give you a percentage. So in simplified terms, if you make $1,000 a month and all of your expenses are $500 a month, that would be a 50% debt to income ratio. So you can see it's allowing you to go higher based on how much income that you make in order to qualify for that loan. So what are the terms on a bank statement loan? You have the ability to utilize an adjustable rate mortgage or a fixed mortgage up to 40 years, and they even offer interest-only products. So for example, if you have a 30-year fixed mortgage, there's programs where you can have an interest-only payment up to the first 10 years. It's important that you do go over with your loan officer all the nuances if you're going to utilize an adjustable rate mortgage or a fixed mortgage. So for example, if your business is starting to grow, but you're wanting to purchase a property, it may be advantageous to take advantage of the lower interest only payment while you write your business, and then you can refinance into a traditional 30-year mortgage or even utilize conventional financing once you filed your taxes and you're showing more gross adjusted net income, is one of the reasons why you would use an interest only payment versus a fully amortized payment. Or the 40-year mortgage, again, the investor is going to stretch out your monthly payment over 40 years, which would lower it versus a 30-year payment, making it easier to qualify for that payment while you continue to grow and then simply refinance into a 30-year fixed term later on, or even utilize conventional financing if you're at the point where, we qualified you with 12 months bank statements, and then the end of next year, you'll have a full 2 years tax returns, which are typically needed when you go the traditional QM route. You can take advantage of those interest only payments in the meantime. It's important to understand though, that the interest only payment is only covering the interest to the bank. So whatever your interest rate is, that's what you're paying the bank on a monthly basis, and you are not paying your principal balance down at all. So whatever your mortgage is, you utilize the interest only payment, say for up to the full 10-year period. At the end of that 10 years, essentially the loan becomes a 20-year fix. So you will see an increase in payments because although the mortgage is 30-year fixed, it has to be able to pay itself off in that remaining 20 years. In addition, you're using an adjustable rate mortgage and the term is, 5, 7, or 10 years. At the end of that term, if the interest rates are higher than what your initial start rate was, your interest rate can increase, and that would be reflected within your monthly payment. So again, very important that you fully understand all the nuances of utilizing an IO payment or an adjustable rate mortgage, to make sure that it's going to best fit your situation on what you're looking to do with regards to that property. So traditional versus bank statement. Hopefully you're starting to understand that the underwriter on a traditional mortgage simply going to look at your tax returns and your gross adjusted net, whereas on a bank statement loan, the underwriter's looking at what your actual gross deposits are, regardless of what your ending balance is at every month. So using the same person on paper would give you a completely different qualifying income. So pop quiz, which method would you rather utilize, right? So some examples of who this loan would be a good fit for. If you're running an e-commerce business like Amazon or Etsy, or you're a gig worker, or you recently transitioned from being a W-2 wage earner to now running your own business, the good news is you only need to show the current 12 months bank statements for wherever you're at in a year. So typically, when you're trying to qualify for a traditional mortgage, the underwriter's only going to use what your most recent filed tax returns are. So if you filed for the previous year, and let's say currently we're in the month of June, they're not going to take into consideration any of the income that you've earned for this year until you've filed your tax returns. On top of that, even if you are using your tax returns, you still have to provide a year-to-date profit and loss to the underwriter. And if the income's better, they're not going to use it. But if your income is trending down, they're going to use the downtrending income to average your previous year's filed taxes with your year-to-date profit and loss, which to me, again, for as long as I've been in this business, makes no sense how you only use something when it hurts the situation and doesn't better the situation, right? You would think it would be one set of guidelines for everything. Well, that's just another reason why this bank statement program is so fantastic. If you, for example, started your business June of last year, and now we're in June of this year, you can use the 12 months bank statements and take all of the deposits for the entire year. And maybe your business took off, January of the year that you're in, and the majority of the entire income that you made is within 6 months. We would average that over a 12-month period, but now you can see that you're using the entire income from the current year that you're in, regardless of the fact that you have not filed taxes yet. We're also not going to ask for a profit and loss statement. Your bank statement is your income. It's using those deposits that go in. So as long as they're derived from your profession, they're considered usable income once we apply that expense factor, right? The other thing is if you have gaps in employment, right? So if you started one job and maybe working at that job and then you move to the next job and now you don't have a history at the previous job, all of these things are looked at when you're utilizing like the, qualified conventional mortgage standpoint. This is a vehicle to get you into your home. Or another example of how the bank statement loan works is you can actually commingle your income. So let's say you do work a traditional 9-to-5 wage earner job and you receive a W-2, but you have a side hustle where you have an e-commerce business, or maybe you're a rideshare driver and you're bringing in that additional income. You can actually take all of the W-2 gross wages, just like you would when going the conventional route, and add all of that income from your secondary business and combine that to equal your total qualifying income. So why that's so powerful is, again, going back to the qualified mortgage route, because the underwriter is going to look at your tax returns, not only are they only going to use the most recent year's filed tax returns, but if you wrote off all of that income using your, legal tax deductions at the end of the year, and that business actually shows a loss on your tax return, not only will there be no income available from that secondary job, but they're actually going to deduct that loss from your wages of your primary job. So for example, if you make $100,000 a year in gross wages at your W-2 job and you showed a $20,000 loss on your side hustle, you only have $80,000 in usable income going the conventional route. They're going to only take that income, whereas on the bank statement loan, we're going to use 100% of your gross wages, and all of that income that was deposited into your bank statements. So how is that bank income actually calculated? I'm going to actually head over to the seimortgage.com website where we have a mortgage calculator where you can actually calculate your own proposed bank statement income to see what your qualifying income would be to purchase a house. So you can see how the bank statement loan is such a powerful loan product in comparison to a traditional conventional loan. If you made $100,000 in gross income, but when you filed your tax, you only showed $20,000, that's only $1,600 in monthly income. Whereas if you had $100,000 go into your bank statement, right, on over a 12-month average, and even using a 50% expense factor, meaning they're only going to use $50,000 of your income, that's more than double. That's $4,166 in qualifying income that you can use to purchase your property, in addition to having the ability to go up to a 55% debt to income ratio. So what are the down payments associated with a bank statement loan? That's really where the only rub comes in. Unfortunately, you can't utilize the down payment assistance programs or first-time home buyer or grant products. Those are only available for traditional, qualified mortgages, conventional finance. So on a bank statement loan, currently the minimum down payment is 10%. So you'd have to put a 10% down payment if you're purchasing a primary residence. But the good news is that 10% down payment does not have any monthly mortgage insurance associated with the payment. So that means whatever your interest rate is on that 10% down payment, you're only going to be paying the principal and interest payment in addition to your property taxes and homeowners insurance. Whereas on a qualified mortgage, when you're putting less than 20% down, typically you have to have a mortgage insurance premium or MIP, because that's essentially insurance on the loan for the investor if you should ever default on the payment. So what do interest rates look like on this program? That's one of the myths that we did bust in the previous episode, that bank statement loans or other products like this come with high interest rates. That's actually not the case. If you're going with, say, a standard 20% down payment on this bank statement product, the interest rates are often only an eighth to maybe 1/4% higher than what it would be on a conventional loan. If you're utilizing a fully amortized product, the entire way, or wait until interest rates drop. So you can utilize this loan product if your business is starting to grow and have the ability to purchase a property and still have a very competitive payment while you either wait for interest rates drop to, move into a refinance market, which hopefully that happens sooner rather than later. Or you have the option to use an interest only payment, where those programs are not available in the conventional space. So you can't use this 30-year fix with the first 10-year interest only program. And again, if you use that product, that also will not have any monthly mortgage insurance associated with it. So it's just the interest only payment based on the mortgage balance in addition to your taxes and insurance. So there's so many nuances available with the bank statement loan, how you can use it as a vehicle when you're purchasing a property. If you're buying second home or investment property, again, you can use the bank statement loan on an investment property. You do have to put a minimum of a 20% down payment on an investment property. But guess what? If you're buying a multi-unit property that's 2 to 4 units, you cannot use conventional financing unless you put a 25% down payment or greater. So this product allows you to put 5% less down, and you also have the ability, again, if you want to utilize an interest-only payment. If your intention is to just make sure you're breaking even on that property or positive cash flowing while you write that property, meaning you're going to put some money into the property, you're going to get it up to fair market rent and then refinance that loan later, or interest rates drop and you refinance that loan later, you have the ability to make sure that you're covering all in on the investment piece. So you're at the very least breaking even. So the bank statement loan, simply put, It translates real deposits into qualifying income. It is truly built for the self-employed borrower in mind. Because why shouldn't you have the same opportunities as a wage earner just because you have an entrepreneurial mind? You took a chance on yourself and made a profitable business offering your products and services just for the banks to tell you no. Sorry, you can't play in our sandbox. Go get a W-2 job and call us back. You're not unqualified. You're just mismatched with the wrong loan product. For tons of additional tools and resources or to qualify your bank statement income, head over to seimortgage.com, linked in the description, along with our free loan calculator. Check out our next episode explaining QM versus non-QM on the screen now. Thanks for listening. And remember, let your money work smarter for you, not harder.